Okay, Ji, welcome back. We were discussing about depreciation. So, we'll be recording entries as depreciation expense debit and accumulated depreciation credit. And then we recorded two depreciations. One was without salvage value, the other was with salvage value. So, that should have been recorded as 1.5 million. And then your accumulated depreciation 1.5 million. So this was one method. There are other methods of calculating depreciation as well. For example, since since we discussed number of units produced, for example, if a life of machine is given as that it will produce 2 million units. Obviously, the more you use it, the more depreciation you can claim. This could be easily transformed to number of kilometers driven. This would become right. And then we discussed about tractor, for example, number of hours consumed, used, right? So you can apply all these uh, quantitative production methods or usage methods on this. So you can easily get the per unit depreciation rate when you have cost, number of units, kilometers, or hours, whatever you're using, right? So it's the same thing. You're writing basically life cost divided by life, but difference is that you have a different type of life here. It's not in terms of years now, it's in terms of its capacity, how much it can drive, how much it can produce, how much it can be used. So is the same way. If you have a salvage value here, so you will change the formula to this number of units produced, kilometers driven, hours used. So this is your second method. If you take example, for example, we take the same cost, 5 million. Now we have life as such in, if it says that 2 million units production capacity. So you can calculate the per unit cost, sorry, depreciation rate, which will be 5 million divided by 2 million, in this case 2.5 per unit is the depreciation. So if you produce like 20,000 units in first year, then its depreciation should be depreciation should be depreciation expense should be calculated as 20,000 divided by 2.5, which in this case will become 50,000, right? So this was your second method. Third method is an accelerated depreciation method, uh, normally and most generally called as double declining balance method. So since you have the straight line method depreciation rate, so you can multiply that rate by 2 and then you calculate your depreciation. For example, you're taking the same 5 million but with salvage value of 0.5 million. So this is the cost, this is the salvage value 5 million, and life is 3 years, right? So your depreciation rate in this case, straight line method depreciation rate we're talking about, becomes 5 minus, okay, you don't need to, depreciation was 1 divided by, sorry, depreciation was straightforward, 1 divided by its life, so which in this case is 33 point. So you simply take the cost, you take the rate, and then you calculate the remaining value. So you have first year, your cost was 5 million. Depreciation rate is obviously constant. So you multiply this 5 million by 33.33, and then you get what? 5 million multiplied by 33.33 is 1.66 million. Sorry, I'm redrawing this. I missed one column. So you have rate, you have depreciation for the year, and then you have remaining value. So you have 5 million, your rate is 33.33%, your depreciation expense for the year is 1.66 million. And then you have the remaining value, which is 5 minus 1.66. This would become 3.34 million. Next year, you have a rate of 33.33%. Now you'll be multiplying 3.34 with, so this would be 1.11, 1.11 million. So your remaining value here would be 3.34 minus 1.1. This would become 2.23 million. So third year, you have 2.23 million, and you'll have to multiply these with 33.33. So you'll get 2.23 multiplied by 33.33. So you get 0.74, 0.74. The difference 2.23 minus 0.74. So you get 1.49 million. So this was uh, declining balance method. Declining balance method. And you can very well see that the ending value here is 1.49, which should have been zero point 0.5 million. So that is why this wasn't popular method. So people use double declining method. So with the same concept, you'll have cost, you'll have rate, depreciation expense for the year, and then you have remaining value. So the cost here is 5 million, but for double declining, you simply, as we stated earlier, you simply multiply the rate of depreciation of straight line method by 2. So here you get 66.66%. So it is 66.66. So you multiply 5 million with 66.66 to get 5 multiplied by 0.6666. So you get 3.333 million for the first year, and your remaining value will be obviously 1.667 million. So when you multiply this 1.667 million with 66.6%, the next year you get 1.67 divided by 0.6666. So you get 1.11 million. So you have a difference of 0.55, to be very exact, 0.556. Okay, 1.19, 557, sorry. So you have 0.557 million as a remaining value. Third year, you don't need to multiply with this number, so you keep it blank because you want 0.5 million at the end. So 0.5 million at the end. So you just need to have a difference of 0.057 million as your depreciation expense. So this is crucial. You have remaining cost here, right? So you don't multiply it with your uh, rate in the third year. You know that you'll have to find out this difference. You have to have ending value of zero point 0.5 million. So you just need to subtract zero point 0.5 million from this 0.557 million to get a depreciation expense of 0.057 million. So this is how depreciation expense for the double declining method would be calculated. So this was your declining balance method or single declining method, normally not used, because here if you see, if you use the same uh, theorem here, means you can find out the ending, the ending value 0.5 million. And what is going to happen here, you're going to have the highest depreciation at the end. For example, 2.23 minus zero point 0.5 will give you 0.73. Yeah, 1.73 million depreciation. So highest, uh, high depreciation, low depreciation, and then the highest depreciation. So this makes the payments or the statements uneven. So that is why this declining balance method is normally not preferred. Most of the organizations use double declining balance method. So they would settle like this in the last year specifically. Uh, During the running years, they will easily be multiplying the double declining rate with the remaining cost and compute the depreciation expense for that specific year. Any questions still here, please? Anybody? Okay. So we have next method, sum of years digit method. Example, here we had life of 3 years. So here we had life of 3 years. So sum of year digit method asks us to add all these years. So you had 1, 2, 3 before 3 years. So you would add these numbers, you'll get a total multiplier of 6. So now you can easily uh, find out the depreciation for the first year. So if you are using accelerated method, so first year depreciation would be the last year's number divided by the sum, which is 6. So I would write it as last year's number divided by their sum, and then you multiply it by cost, you get the depreciation. Here the ideal is that if you are provided with the salvage value, you do it like this: cost minus salvage value. So in this case, you have 3 by 6 multiplied by cost minus salvage value is 4.5 million. So the first year's depreciation in this case would be 2.25. Yep. Then for second year, you do this 2 divided by 6 multiplied by 4.5 million. So in this case, it becomes 1.5 million. And then third year depreciation would be this would be 1, the first divided by 6 into 4.5 billion. This comes to be 0.7. All in all, these three, when added, will become 4.5 million. So we have already left out the salvage value, so you don't have to worry about it. So this was accelerated method. If it is slow, or generally called decelerated method, but normally it's not in practice at these days. So your third year's depreciation would become first year's. How? First year depreciation was 1 by 6 by 4.5. So this gives you 0.75 million. Second year remains same. 6 multiplied by 4. Third year is the highest, since it has the highest weightage by 6. So for year is, I will put a question mark on these. These are not in practice, decelerated method. Similarly, your uh, single declining or declining balance method is a question mark. Don't use it. Most of the organizations use the simple depreciation calculation method, which is number of units produced or the straight line method. But that obviously depends on the nature of the business as well, because most of the businesses, uh, they differ as to what they are producing and what kind of assets they are using. So it varies from business to business. Any questions still here, please? Okay, then there is another method which is most commonly now in practice. This is called Macros. So this is modified accelerated depreciation rates, right? So these rates for every type of asset, for example, 1 year life asset, 3 year life asset, 5 years, 4 years, the rates are given. For example, 1 year rate would be given as in two numbers. For example, it will be given as 65% and then 35%. So now you have rates. So this is basically adjusted in two accounting periods. Then if you have 3 years, then you'll have four rates. So you'll have to accommodate among these four accounting years. For five, you accommodate them in six accounting years, and so on. So for every asset class, you have certain percentages provided to you. So it's not an issue that You don't need to calculate a certain percentage. You just have to uh, find the MACUS table and your class of asset. If it's 3 years, 4 years worth, means having life. So you'll be just taking those percentages and multiplying it by cost. Okay, MACUS depreciation. I want to write the exact values. You do have these in your book, so okay, we have number of assets classified as, for example, 3-year property. Uh, we have, for example, tractors, right? Race horses over 2 years. So they utilize the 3 years property. When you look at the 5 years property, you have automobiles, taxis, trucks, computers, uh, other breeding cattle comes in under this class as well. Okay. For a 3-year class, we have 33.3% first year, 44.45% in the second, 14.81% in the third, and 7.41% in the fourth. For a 5-year class, we stated that the first would be 20%, then 32%, and then 19.2%. We had 11.52%, 11.52%. The last year we'll be having 5.76%. So we have these tables given, so we will be using these numbers. So for a 3-year class, we were using 5 million asset. So in the first year, it should be 33.33%, which is 1.667 million. In the second year, 5 million should be multiplied by 4.5%. So this becomes how much? It's equal to 5 multiplied by 0.4445. So this becomes 2.2225 million. In the third year, this would be 14.81%. So it's equal to 5 multiplied by 14.1481. So this comes to be 0.7405 million. And in the last year, you'll be multiplying it by 7.41%. 0.41%. In this case, it comes to be 0.3705. So all in all, this sum should become total depreciable amount 5 million, which we are depreciating. So in this case, if you had salvage value, so you should multiply these rates with 33.35 with 4.5, because formula here is depreciable value. And how do you find it? Same cost minus salvage value. So in the straight line method, your uh, cost minus salvage value is basically depreciable value. So you need to multiply these rates with your depreciable value. So when you have a salvage of 0.5 million here, so you'll be multiplying all these and getting a new answers, obviously. But then the all the answers should add up to 0.5 million. This needs to be kept in mind. Any queries, please? Are you people listening? Hello. Okay, you're replying in chats. Yeah, you don't want to turn on your mics and reply. Anyhow, okay, that's good. If you're a little too fast, then